Picking the right dividend ETF feels like a high-stakes decision, because it is. You have two titans, SCHD and VIG, both promising security and income. But they follow completely different playbooks, and choosing the wrong one for your specific goals can set your retirement back by years. Today, we're settling the debate with real numbers. We're comparing two of the best dividend ETFs on the market, Schwab's SCHD and Vanguard's VIG. Which one gives you a better return? Which is safer in a market crash? And most importantly, which one grows a $100,000 investment more? I've run a full backtest, and the results are not what you might think. We'll break down exactly what you're buying, how they perform under pressure, and which one is the right tool for your financial goals. You see two top-tier dividend ETFs, but they hunt for stocks in completely different ways. Understanding their core philosophy is the only way to know which one truly fits your goals. Let's start with SCHD. Think of it as a quality value hunter. It tracks the Dow Jones U.S. Dividend 100 Index, which acts like a strict financial auditor. It doesn't just look for any company paying a dividend, it runs a deep financial background check. To even be considered, a company needs at least 10 straight years of dividend payments. But that's just the first hurdle. From there, it gets even tougher. The index screens for 4 key metrics of financial health. First, high return on equity, which shows how effectively a company is at generating profit from its assets. Second, strong cash flow relative to its total debt, ensuring it isn't drowning in leverage and can actually afford its dividend. Third, it looks for a high current dividend yield. And finally, a high 5-year dividend growth rate to show the payout is heading in the right direction. This intense, multi-factor process filters the market down to about 100 elite, fundamentally sound companies that are already paying out a generous and sustainable income stream. The entire philosophy is to get paid well today from the most financially robust companies. Now for VIG. Think of it as a quality growth talent scout, looking for proven long-term performers. It tracks the S&P U.S. Dividend Growers Index. Its primary rule is brutally simple but incredibly powerful. It only includes companies that have increased their dividend for at least 10 consecutive years. It doesn't screen for a high starting yield. In fact, it often excludes the highest yielding companies, seeing them as potential risks. It only cares about the track record of consistent growth. A company that can raise its dividend for a decade straight through good times and bad is signaling immense financial strength, a durable competitive advantage, and a management team that is confident in the future. This approach results in a much broader portfolio of over 300 companies that have proven their ability to reward shareholders year after year. The core difference is their priority. SCHD is built to maximize high, stable income right now from companies that pass a rigorous financial health exam. VIG is built to capture the future potential of companies with an ironclad history of growing their dividend payments, betting that this growth will lead to superior returns over the long run. Before we even look at what these funds own, let's talk about the one thing you can absolutely control: cost. Both of these funds are champions of low-cost investing. SCHD has an expense ratio of just 0.06%, while VIG is even cheaper at 0.05%. On a $10,000 investment, that's a difference of just $1 a year. The key takeaway isn't that one is better, but that both are incredibly cheap. This low cost is a massive advantage for long-term investors and a core reason why they are such effective investment tools. The tickers might look similar, but under the hood, these funds are making completely different bets on the future of the American economy. SCHD places its biggest bets on more cyclical and value-oriented sectors. It has a heavy allocation to energy at around 18%, consumer staples at 19%, and healthcare at 14%. This portfolio is tied to the tangible physical economy. When you look at its top holdings, you see this strategy in action. You're buying companies like Chevron, a global energy giant, Coca-Cola, the world's largest beverage company, and Texas Instruments, a critical semiconductor manufacturer. Because it holds only about 100 stocks, it's more concentrated. Its top 10 holdings make up over 40% of the fund, meaning the performance of a few key names has a big impact. VIG's portfolio tells a different story. It's led by information technology at nearly 24%, and financials at 22%. It's making a much bigger bet on innovation, software, and the growth of the digital economy. Its top holdings are a who's who of modern commerce: Microsoft, the software and cloud computing titan; Apple, the world's most valuable consumer electronics company; and Visa, a global payments technology leader. With over 300 stocks, it's far more diversified, and its top 10 holdings only account for about 32% of the fund, spreading your risk much more widely. There's almost zero overlap in their top 10 holdings. They are genuinely different investment tools making different bets on the economy. With SCHD, you get a concentrated portfolio focused on value, tangible assets, and the physical economy. With VIG, you get a broadly diversified portfolio focused on technology, innovation, and the digital economy. Total return gets the headlines, but what is the real engine driving the long-term results for these funds? Let's look at what truly powers their performance. Let's start with SCHD, the fund for investors who want cash now. Its main appeal and a primary strength is its high current dividend yield, which consistently hovers around 3.5% or more. For every $100,000 you invest, SCHD might pay you $3,500 a year in cash. That's a significant, tangible income stream that can be used to pay bills or be reinvested. This is incredibly attractive for retirees or anyone prioritizing current income over total growth. VIG plays a different game. Its strength historically has been its higher total return. While its starting yield is much lower, often below 2%, its engine is overall growth. Looking at the compound annual growth rate since October 2011, VIG has delivered 12.53% per year, compared to SCHD's 11.42%. This higher compound annual growth rate, which includes both price appreciation and dividends, is the primary driver behind its long-term outperformance in total value. When you invest in VIG, you're betting on the combination of these factors to deliver a superior total return over time. This is the fundamental trade-off. SCHD offers a superior income stream today. VIG has historically offered a superior total return, as measured by its higher compound annual growth rate. The choice comes down to what an investor values more: immediate cash flow or long-term total portfolio growth. High returns and growing dividends are great in a bull market, but preserving your capital is what keeps you in the game. Which fund holds up better when the market panics? Let's look at the 2022 bear market, a period defined by high inflation and rapidly rising interest rates. This environment was brutal for growth stocks. SCHD's value-oriented portfolio, with its heavy exposure to energy and industrial companies that can benefit from inflation, proved its worth. It held up better, with a maximum drawdown of only negative 19.5%. This demonstrates its strength as a defensive holding in a specific type of economic crisis. In that same 2022 crash, VIG's portfolio, with its heavy weighting in technology and growth stocks, was hit harder. It fell further, with a drawdown of negative 21.8%. However, let's rewind to the sudden, fear-driven COVID-19 panic in March 2020. In that scenario, both funds fell by a very similar amount, around negative 32% to negative 33%. This shows that in a broad, indiscriminate market panic, the differences can be minimal. The key takeaway is that the type of crisis matters. The winner in a crash changes depending on the cause. SCHD's value tilt offers better protection in an inflationary, rising rate environment. VIG's quality growth profile may be more resilient in other types of downturns. However, the most important point is that in both major crises, both funds fell significantly less than the broader S&P 500, proving their value as defensive anchors in a portfolio. Managing your portfolio shouldn't be guesswork, but most brokers hide the full picture. They don't include dividends, they don't factor in currency changes, and they definitely don't make tax time easy. That's where ShareSite changes the game. It shows your true performance, tracks every dividend, gives you clear diversification reports, and makes tax reporting painless. And with my exclusive link in the description, you'll get 4 months free when you sign up for the annual plan. Start investing smarter today with ShareSite. We've looked at strategy, holdings, and performance in a crisis. Now for the main event. What happens when you put $100,000 into both funds back in October 2011 and let it grow for over a decade? Let's get right to it. After more than a decade of dividends, market crashes, and historic bull runs, that initial $100,000 investment in SCHD would have grown into a final portfolio worth $404,554. This represents a compound annual growth rate of 11.42%. This is a fantastic, life-changing return, but here's where it gets really interesting for an income investor. Based on its current dividend yield of around 3.5%, that final portfolio would now be generating over $14,000 a year in passive income. That's over $1,100 a month in cash flow without selling a single share. However, the same $100,000 invested in VIG on the same day would have grown to $470,390. That's a difference of nearly $66,000 in VIG's favor. VIG achieved this with a higher compound annual growth rate of 12.53% over the same period. The seemingly small 1.11% difference in annual returns compounded into a massive difference in wealth over 13 years. But what about the income? Based on VIG's lower yield of around 1.8%, that larger portfolio would be generating about $8,500 a year in passive income. The backtest reveals a fascinating split decision. VIG was the clear winner on total return, growing the initial investment to a much larger final sum. However, SCHD's final portfolio, while smaller, would be generating significantly more annual income, over 60% more than VIG's. This perfectly illustrates the trade-off. The data shows there's only the best fund for you. Choose SCHD if you are an income-focused investor in or nearing retirement. Your primary goal is maximizing safe, reliable cash flow today. The higher current yield and the substantial income stream it produces are more valuable to you than chasing the highest possible total return. Choose VIG if you are a long-term accumulator with a multi-decade time horizon. Your goal is to build the largest possible nest egg. You are willing to accept a lower current yield in exchange for a higher potential total return driven by its powerful compound annual growth rate. So, are you on Team SCHD for income or Team VIG for growth? Let me know in the comments. If you want more data-driven ETF comparisons like this one, subscribe and then click the video on your screen to see my next deep dive.